Joseph Kennedy didn't guess the 1929 crash. Michael Burry didn't stumble into the 2008 collapse. Bill Ackman didn't turn $27 million into $2.6 billion in 2020 because of luck. These men didn't get lucky. They recognized a sequence forming beneath the surface long before the public sensed anything was wrong. And right now, in 2025, that exact same sequence is beginning again. This isn't luck. This isn't timing. This is a pattern. A pattern smart money follows with mechanical precision, while ordinary investors walk straight into the furnace, believing everything is normal. Every major market breakdown, 1929, 2000, 2008, 2020, began the same way. Insiders moved first, hedges appeared quietly, risk piled up under record highs, and the public cheered the exact moment they should have been terrified. What Kennedy saw in 1929, what Burry dissected in 2005, what Ackman executed in 2020, those same fingerprints are visible right now. The richest and most informed people on earth are already taking positions that signal something much larger than profit-taking or portfolio adjustments. Warren Buffett is sitting on $325 billion in cash. Jeff Bezos is unloading billions in Amazon stock. Corporate insiders are selling at the fastest rate since 2007. Hedge funds are buying volatility protection months before the public feels nervous. These people never wait for the crash. They position before it. And they can position because they understand something the public doesn't. Markets don't move randomly. Beneath every bubble, every surge, every collapse, there is a 4-stage cycle that repeats with brutal consistency. Not noise, not chaos. A structure, a roadmap, a pattern hidden in plain sight. And right now, that pattern has already begun. There is a cycle beneath every market that doesn't care about optimism, headlines, or investor confidence. It behaves the same way in every decade, through every technological shift, under every economic backdrop. Smart money knows it. Retail investors never see it. And once this 4-stage sequence starts, it does not stop until the final move plays out. Stage 1 is the silent exit. Insiders begin selling while prices still climb, and public sentiment is euphoric. They don't need to predict the crash. They only need to recognize when risk has already flipped against the crowd. Stage 1 is always invisible until months later, when investors finally realize the people they trusted were selling into their enthusiasm. Stage 2 is the hedge. This is where the sophisticated players begin buying volatility insurance, protection that bleeds money at first but becomes priceless when the system cracks. To the public, hedging looks paranoid. To smart money, it is survival. Stage 3 is targeted shorting. Not broad panic, not emotional selling, precision strikes. Specific sectors, weak companies, overstretched balance sheets. Smart money knows exactly which beams in the house are rotten. And stage 4 is the return. When fear is at its peak and markets are burning, the same investors who exited early come back with massive reserves of cash to buy everything at fire sale prices. It's the moment retail investors run away and smart money builds empires. Exit, hedge, short, accumulate. A pattern repeated for a century. And right now, it's already unfolding. Stage 1 is always silent, always invisible, always the moment the public feels safest, right when the smartest people in the market begin leaving. It never looks dramatic. It never looks suspicious. It looks like stability. It looks like strength. And that's why almost everyone misses it. In the summer of 1929, Jesse Livermore spent months reviewing balance sheets, price action, and debt levels. He saw the same thing Joseph Kennedy saw, a market fueled not by earnings or productivity, but by leverage stacked on leverage. Brokerage firms were handing out margin like candy, and ordinary people were borrowing money they didn't have to buy stocks they didn't understand. Livermore didn't predict a date. He didn't need to. The conditions were enough. He unwound positions while newspapers bragged about the permanent prosperity of American markets. He cashed out while the crowd was still celebrating. Weeks later, the floor collapsed. Stanley Druckenmiller made the same move 7 decades later. In 1999, he watched tech companies trade at valuations detached from reality. No profits, no business models, just hype and liquidity. He held back, then briefly gave in to the mania in early 2000 and instantly regretted it. His instinct had been right. The exit should have happened before the crowd went insane. When the bubble burst, he didn't lose because he was wrong. He lost because he ignored stage one. It haunted him publicly for years, and he warned investors about it for the rest of his career. The moment you feel invincible is the moment you should run. Michael Burry executed stage one with surgical precision in 2005. While Wall Street bragged about endless home price growth, he combed through loan-level data and watched underwriting standards decay into fraud. Borrowers with no income, no assets, no verification, adjustable mortgages destined to implode. He pulled away from the consensus. He cut exposure. He exited the guaranteed win trade before anyone else realized the floorboards were rotten. He wasn't guessing. He was observing what the public refused to see. And right now, in 2025, the same fingerprints are showing again. Warren Buffett is holding more cash than at any point in Berkshire Hathaway's history. Not because he's cautious, because nothing is worth buying at these prices. When the world's greatest value investor refuses to deploy $325 billion, it isn't hesitation, it's indictment. It's the clearest signal stage one is underway. Jeff Bezos has unloaded billions in Amazon stock. Systematic selling, not symbolic selling. Meanwhile, Meta insiders have sold into every major rally. Apple executives have shifted compensation packages away from stock. These aren't coincidences. These are exits disguised as diversification. Insider selling across the S&P 500 is hitting levels not seen since 2007. The people running the world's largest companies, the ones who see the real numbers months before the public, aren't betting on the future. They're cashing out while optimism is peaking. Look deeper. Corporate buybacks, the engine that inflated stock prices for a decade, are slowing sharply. Late-stage VC funds are demanding liquidity instead of growth. Private equity firms are offloading portfolio companies at discounts, even when it hurts their optics. These are not bullish behaviors. These are pre-crisis maneuvers. Stage one is never loud. It doesn't announce itself. It isn't a headline. It's a transfer. Stock flowing quietly from insiders to retail investors who think they're buying the dip, not realizing they're absorbing the exits of people who know better. The public thinks crashes begin when panic starts. They don't. Crashes begin when confidence is highest and insiders are already gone. Stage one is the door closing softly before the alarms go off. And in 2025, that door is already shutting. Stage two is where the smart money stops playing offense and starts preparing for impact. The public sees calm markets and thinks it means safety. Professionals see calm markets and know it's the last moment to buy insurance before the fire starts, because volatility doesn't appear out of nowhere. It builds quietly, invisibly, underneath the surface. And stage two is when the people who actually understand risk begin protecting themselves. In 1929, after Jesse Livermore and Joseph Kennedy exited early, they didn't just sit on cash. They positioned for the downside. Short selling was the only form of volatility insurance available at the time, and they deployed it strategically. It cost money to maintain. It looked ridiculous while stocks kept rising. But when forced liquidation cascaded through Wall Street, their insurance detonated into life-changing profit. They weren't predicting the crash. They were hedging against math. Michael Burry understood the same principle in 2005. Credit default swaps were the modern equivalent of fire insurance. Cheap, ignored, and considered unnecessary because the housing market never went down. He paid millions in premiums for instruments that produced zero returns for nearly 2 years. His investors protested. Some begged to withdraw funds. Others threatened lawsuits. But Burry didn't care. He wasn't buying insurance for the present. He was buying it for the disaster he knew was already baked into the system. And when subprime defaults accelerated, his swaps printed hundreds of millions. John Paulson saw the same thing. Bill Ackman perfected it. In early 2020, while the world was still debating whether COVID mattered, Ackman quietly bought corporate bond insurance. He spent $27 million. 3 weeks later, as fear exploded, those swaps paid out $2.6 billion. Not because he timed the virus, because he executed stage two with discipline. And in 2025, stage two is happening again, right in front of anyone who knows where to look. The put-call ratio has remained elevated for months. That doesn't move because retail traders are buying protection. It moves when institutions are building large downside hedges. VIX call options, bets on violent spikes in volatility, are being purchased in sizes that only hedge funds and pension giants can afford. These aren't speculative YOLO trades. These are defensive positions placed by people who understand that the calm we're seeing is artificial. Credit default swaps on corporate debt are surging in cost. That only happens when sophisticated investors believe companies will struggle to refinance or survive an interest rate environment they weren't built for. Commercial mortgage-backed securities, in particular, are flashing red. The cost to insure against commercial property defaults has skyrocketed. That is the market screaming the truth before the headlines catch up. Even more telling, large funds are quietly adjusting their portfolios to reduce exposure to the riskiest debt while increasing liquidity. They're not saying this publicly. They never do. But the filings don't lie. Reduced leverage, longer dated protection, higher cash buffers. These are moves made only during stage 2. And then there's the ultimate form of volatility insurance, cash. Warren Buffett sitting on $325 billion is not caution. It's a defensive stance. It's a shield, a strategic hedge disguised as patience. Cash is the most powerful volatility weapon because it allows you to buy when everyone else is being liquidated. Bill Ackman has hinted publicly that he's hedging again. Ray Dalio has been warning about reverse bubbles for months. Global macro funds are increasing tail risk hedges, rare, expensive positions designed to explode only when markets fall off a cliff. Retail investors look at these moves and think, why hedge now? Everything's going up. Exactly. That's when stage 2 always happens. Insurance is cheap when danger feels distant. Insurance becomes priceless when it finally arrives. And the people who understand this aren't waiting for the panic to begin. They're already positioned for it. Stage 2 is the quiet loading of ammunition before the battle. The moment when professionals stop asking if a crash is coming and start preparing for when it hits. And in 2025, the insurance is already being purchased. Because stage 3 is next, and that's when the knives come out. Stage 3 is when the quiet preparation ends and the precision strikes begin. This is the stage the public never sees until it's too late. Because stage 3 isn't about hedging the market. It's about identifying exactly which sectors will break first, then positioning to profit from their collapse. Smart money stops thinking broadly and starts thinking surgically. In the early 2000s, Michael Burry didn't short the entire housing market. He shorted the exact mortgage tranches that had the highest concentration of fraud, adjustable rates, and guaranteed failure. He pinpointed which loans would reset first, which geographic areas would implode earliest, which bonds were structured to collapse under even the smallest stress. It wasn't luck, it was math. And when those subprime layers cracked, his positions detonated. John Paulson took it further. He didn't just bet against housing, he bet against the institutions built on top of it. Bear Stearns, Lehman Brothers, Washington Mutual. The bank's analysts insisted we're safe. The bank's regulators sworn we're capitalized. The banks whose business models were already dead. Paulson wasn't guessing who would fail. He read their balance sheets. He saw their exposure. He watched their leverage climb past the point of no return. When the dominoes fell, his shorts printed billions. Stage 3 is always like this, not panic, precision. And in 2025, that precision is pointing at 2 sectors with blinking red lights: commercial real estate and regional banks. Commercial real estate is not in trouble. It's in free fall. Office buildings across major U.S. cities sit half empty. Corporate leases are shrinking. Remote work has permanently rewritten demand. Buildings that were financed at 3% interest now need refinancing between 7% and 9%. The math doesn't work. The cash flow dies. The loans default. Owners hand back the keys. This is not speculation. It's happening already. Entire skyscrapers in San Francisco, Los Angeles, and Chicago have been abandoned by institutional owners because the debt is worth more than the building itself. Hedge funds aren't shorting office towers directly. They're shorting the financial instruments tied to them. Commercial mortgage-backed securities, default swaps on CRE debt, equity of REITs holding toxic portfolios. These instruments are behaving exactly like subprime mortgage bonds behaved in 2006, stable on the surface, rotten inside. And the lenders holding these time bombs? Regional banks. Regional banks are the weakest link in the U.S. financial system. They hold the bulk of commercial real estate loans, not the big banks, not the hedge funds. Local and mid-sized banks with limited diversification and thin capital buffers. The exact kind of institutions that collapse when loan losses spike. We saw the preview in 2023 when Silicon Valley Bank, Signature Bank, and First Republic imploded, not from recession, not from a crash, but from structural fragility. That was a tremor. Stage 3 predicts an earthquake. Smart money is reading the call reports, the loan books, the exposure maps. They know which banks lent aggressively in dying downtowns. They know which banks loaded up on long-term bonds that collapsed in value when rates rose. They know which banks face refinancing cliffs in 2025 and 2026 that will vaporize their balance sheets. And they are shorting them. Short interest in specific regional banks has surged. Not the entire sector, just the most vulnerable institutions. Funds are borrowing shares and selling aggressively. Others are buying deep out-of-the-money puts, options that only pay off if a stock collapses 50-90%. Those options are cheap now. They won't be cheap when defaults start hitting headlines. This isn't doom. It isn't fear-mongering. It's the exact same pattern that played out in 2007 when insiders quietly piled into shorts on Countrywide, New Century, IndyMac. The early failures of the housing crisis. Stage 3 is the part of the cycle where everyone thinks the worst is over, while smart money is positioning for the real disaster. They don't announce these trades. They hide them. They accumulate slowly. They avoid attention. Because stage 3 is not about timing a crash. It's about being in position when the stress finally snaps the weak beams of the system. Commercial real estate is cracking, regional banks are standing on it, and hedge funds are placing their bets. Stage 3 is underway, and stage 4 is where the real wealth transfers happen. Stage 4 is where the game ends for the public and begins for the elites. This is the moment every previous stage was preparing for. Stage 1 gets you out early. Stage 2 protects you from impact. Stage 3 pays you while everything breaks. But stage 4, this is where generational wealth is built. Not by timing the top, by owning the bottom. Crashes don't just wipe out wealth, they redistribute it. Money doesn't disappear, it moves. It flows from the terrified to the prepared, from the over-leveraged to the liquid, from retail panic sellers to institutional buyers with unlimited patience and unlimited cash. When the world thinks the system is ending, stage 4 players quietly begin shopping. Go back to 1932. The Dow was down 89%. Families lost homes, businesses folded, bank runs happened weekly. But Jesse Livermore, Joseph Kennedy, and Bernard Baruch, who had exited early and profited during the collapse, began buying stocks, railroads, and foreclosed properties for pennies on the dollar. Kennedy bought distressed real estate in Boston and New York that later turned into empire-defining holdings. He didn't need perfect timing. He just needed cash when no one else had it. Fast forward to 2009. The S&P hit 60x. Investors fled the market in the greatest panic of the modern era. But Warren Buffett wasn't panicking. He was writing checks, $5 billion to Goldman Sachs, structured with a guaranteed dividend and warrants that turned into billions more. Billions to Bank of America. Billions into companies whose share prices had been obliterated by fear, not fundamentals. Buffett wasn't being brave. He was following the pattern. Fire sale prices always follow systemic panic. And in March 2020, Bill Ackman executed stage 4 with surgical precision. After turning $27 million in insurance into $2.6 billion, he immediately deployed that capital into companies that were being liquidated by margin calls and institutional de-risking. Hilton, Lowe's, Starbucks, restaurant brands, all crushed by panic, not insolvency. Within months, those positions doubled and tripled. That's the essence of stage 4. Buy when the world is forced to sell. And in 2025-2026, the world is setting up for another forced liquidation cascade. Commercial real estate defaults will hit lenders first, then borrowers, then derivative holders. Regional banks will fail in clusters, triggering deposit flight and accelerated liquidation of loan books. Equity markets will convulse as margin calls fire across retail brokerages and institutional desks. Forced sellers will outnumber willing buyers by orders of magnitude. That imbalance always creates the same thing, prices that make no sense. This is where the cash from stage 1 becomes a weapon. Buffett's $325 billion is not dry powder. It's ammunition. It's fuel for stage 4. Private equity giants, Blackstone, KKR, Apollo, Carlyle, have raised more capital in the last 36 months than at any time in history. They aren't waiting for good times. They're waiting for collapse. They're waiting for skyscrapers marked down 50-70%. They're waiting for companies forced into restructuring. They're waiting for debt holders begging to sell at any price. Hedge funds with massive short position profits from stage 3 will rotate instantly into deep value accumulation. Debt funds will buy defaulted commercial mortgages at 20 cents on the dollar. Sovereign wealth funds will step in to acquire entire portfolios of U.S. assets, while domestic investors are paralyzed by fear. This isn't theory, it's historical repetition. After the dot-com crash, firms bought busted tech infrastructure for pennies and sold it for billions years later. After the housing crash, Blackstone accumulated tens of thousands of homes and built the largest rental empire in America. After COVID, institutions bought distressed corporate debt and equity before the Fed wave lifted everything. The pattern never changes, only the players do. Stage 4 is ugly, it's brutal, it's emotional. Retail investors capitulate, retirement accounts sink, panic dominates headlines, politicians scream for interventions. But while the public looks for someone to blame, the smart money is making lists, buy lists. They're not watching price, they're watching capitulation. They're watching liquidity vanish. They're watching sentiment collapse into despair. Because that's the bottom. And the bottom is where fortunes are made. Stage 4 isn't hope. It's preparation meeting opportunity. It's cash meeting chaos. It's conviction meeting surrender. Stage 4 is coming, and when it arrives, the window will be small. Only those who recognize the pattern early will be ready to walk through it. You've just watched the full cycle unfold. The exits, the hedges, the precision strikes, the fire sale accumulation. This isn't theory. This isn't speculation. It's the blueprint the same type of investors have followed for a century. Quiet, predictable, ruthless. And in 2025, we're already deep inside it. Insiders are gone. Hedges are stacked. Short positions are loaded. Cash reserves are waiting for the panic the public still refuses to believe is coming. But cycles don't wait for permission. They don't care about optimism, headlines, or wishful thinking. They complete themselves. In every collapse, the same thing happens. The crowd realizes too late, the insiders move too early, and the window between fear and opportunity slams shut before anyone knows it opened. Stage 4 is ending. Stage 5 is coming.